I am pouring one out for the bankers today. They were already picking out boat names with those Strava IPO fees.
Please, save your tears. Garmin dropping $2.1 billion is exactly what Strava needed. The public markets would have eaten them alive.
Come on, consumer tech IPOs aren't completely dead.
They are for an app that just tracks my Sunday jogs. Wait until we get into Carlyle's $2.8 billion wealth play.
Now that is a multiple. I need you to explain. The rundown. I just want to take a moment of silence for the syndicate desk that spent the last 6 months drafting Strava's S1.
Oh, please, stop pretending you care about their lost fees. $2.1 billion in cash and equity from Garmin is a massive win.
Sure, but the gossip is incredible. Strava was basically at the starting line of the roadshow. The IPO window is just too volatile right now for consumer tech. Why run an exhausting marathon when Garmin offers you a golf cart to the finish line?
I do not buy the volatile market excuse. I read the integration plan. Garmin is folding Strava's premium tier straight into the Connect Plus ecosystem. This wasn't Strava running scared from public markets. This was Garmin paying a massive strategic premium to completely monopolize the fitness wearable space.
You really think the board wouldn't have preferred ringing the bell on Wall Street?
Not when Garmin is handing over a $2.1 billion sure thing. Founders like certainty.
Fair enough. Let's pivot to the sector that absolutely loves burning cash right now. Biopharma is having a ridiculous first quarter.
19 deals. $46.8 billion deployed in Q1 alone. Everyone is terrified of these looming patent cliffs.
Exhibit A, Eli Lilly just dropped $7.8 billion on Centessa Pharmaceuticals. Huge bet on clinical stage sleep disorders.
And Exhibit B, Francis Servier is paying $2.5 billion in all cash for day one biopharmaceuticals. Cash. No equity theater, just wiring the money.
It is a literal gold rush. Big Pharma is acting like a panicked shopper on Christmas Eve, grabbing whatever pipelines are left on the shelf.
Speaking of grabbing assets, private equity is going aggressively after wealth management today. Carlyle just took a majority stake in MAI Capital, valuing the firm at over $2.8 billion.
Which is wild, but Brookfield Wealth Solutions had to one-up them. They finalized the $3.2 billion buyout of the UK's Just Group. That bumps Brookfield's global insurance assets to $180 billion.
$180 billion. I actually had to read the footnotes on that release twice to make sure I didn't misplace a decimal.
I remember when $100 billion meant something. Now it's just a Tuesday for Brookfield.
We are keeping a close eye on the European life and pension space tomorrow. Chesnara is hinting at a very active M&A pipeline now that they digested HSBC Life UK.
Plus, we need to pull the regulatory filings on that $830 million K-car buyout in South Korea. I want to see exactly how the KG Group Consortium is structuring that debt.
We will tear into those capital structures right after the break. The big one.
I just want to take a moment of silence for the syndicate desk that spent the last 6 months prepping that S1.
Oh, they were already picking out their summer homes. But $2.1 billion in cash and equity from Garmin is a massive mic drop. It just completely nukes the Strava IPO.
It's the ultimate bird in the hand. The IPO window right now is pure chaos for consumer tech. You go on a grueling 3-week roadshow, get chewed up by institutional investors asking about your churn rates, and maybe you price at a $1.5 billion valuation. Or you take Garmin's $2.1 billion today and skip the headache.
I get the board taking the money. What I'm hung up on is Garmin's playbook here. They say they're rolling Strava's premium subscription features directly into the Garmin Connect Plus ecosystem.
Which is brilliant. It creates the ultimate walled garden for endurance athletes.
See, I completely disagree. Strava's entire moat is that it's the Switzerland of fitness data. It doesn't matter if you use an Apple Watch, a Wahoo bike computer, or a Garmin. You still upload to Strava to get kudos from your friends. If Garmin puts up a wall, they kill the network effect.
They aren't going to block Apple Watch users. They're just going to make the Garmin integration so seamless that you feel stupid not buying a Phoenix. You get the hardware margin and the software subscription all in one swipe.
I read the press release 3 times looking for guarantees about cross-platform support. It's suspiciously vague. Usually when a hardware company buys a software platform, they loudly promise to keep it open to everyone. Garmin just talked about, quote, massive consolidation of the fitness market.
Spoken like a true hardware monopoly in the making. But honestly, look at who really wins here. It's not just the Strava founders, it's Garmin playing offense against Apple. Apple Health is heavily creeping into their territory with the Ultra Watch. Buying the social network that all the serious athletes actually care about is the ultimate defensive moat.
$2.1 billion is a steep price for a moat, especially when you look at the equity portion. Garmin stock has to really hold up for this to actually pay out for Strava employees over the vesting period.
True, but would you rather hold Garmin paper right now or try to float a consumer app on the NASDAQ?
Fair point. I just feel bad for the junior bankers who spent their weekends formatting the risk factors section of that S1.
They can log their crying sessions on Strava. I'm sure there's a premium badge for that.
A high-stress zone badge, definitely. Speaking of high stress, though, the biopharma space is practically drowning in cash right now. Eli Lilly just dropped $7.8 billion on a sleep disorder specialist, and they aren't the only ones aggressively buying up pipelines this quarter. Voices.
So the consensus on the street today is that Strava's $2.1 billion sale to Garmin is the ultimate white flag.
White flag on the IPO, you mean?
Exactly. One analyst literally called the consumer tech IPO window treacherous, and honestly, I get it. You have an S1 drafted, you're looking at a grueling roadshow, and then Garmin walks in with a massive cash and equity offer. You take the sure thing. The board definitely panicked.
I don't buy that it was just panic. Yes, the public markets are volatile, but look at the actual product fit. Strava integrates into Garmin Connect Plus and instantly monetizes a massive hardware user base. They didn't just take the money because they were scared. They looked at the numbers and realized they're a premium feature, not a standalone public company.
Oh, come on. You don't pay lawyers to draft an S1 if you secretly think you're just a feature. They wanted to ring the bell. The best part of this whole thing is the absolute tears from the investment bankers who spent 6 months prepping that roadshow. Left out in the cold. Zero fees for you guys. Is for...
Your banker trauma is showing again, Nate.
Hey, I know that pain firsthand, but fine. Let's look at a sector where the bankers are actually getting paid. Biopharma industry watchers are calling Q1 2026 an absolute gold rush.
$46.8 billion deployed across 19 deals. That isn't a rush, that's a stampede.
It's pure panic buying. These major players are staring down massive patent cliffs.
It's strategic panic. Eli Lilly dropping $7.8 billion for Centessa. Servier paying $2.5 billion in all cash for day one biopharmaceuticals. They're plugging holes in their pipelines with clinical stage assets because they have no other choice.
And the cash is just flowing everywhere. Speaking of cash flowing in weird directions, wait until you see the financing structure on that South Korean K car deal.
$830 million to the KG Group consortium. I've been pulling the regulatory filings on that one all morning.
Tell me you found something good in the footnotes. Spill the tea. I honestly can't stop thinking about the junior bankers who were prepping that Strava S1.
Oh, they're completely devastated right now.
Devastated is an understatement. They had the roadshow deck finished, the fonts were perfectly aligned, the private jets were booked, and then Garmin just kicks the boardroom door down with $2.1 billion in cash and equity.
Honestly, it was the exact right call by Strava's board.
Really? You don't think they left a massive pile of money on the table? A fitness tech unicorn with that kind of brand loyalty could have popped 30% on day one of trading.
Absolutely not. Have you looked at consumer tech multiples lately?
I have, but Strava is a verb. People literally say if it's not on Strava, it didn't happen.
Sure, but the IPO window is essentially a trapdoor right now. Taking the sure thing from Garmin was incredibly smart. You don't risk a grueling 6-month roadshow when someone hands you over $2 billion to just hand over the keys.
Spoken like someone who never expected to collect a massive underwriting fee. Those bankers are probably returning their fleece vests as we speak.
I'm just saying, the board looked at the volatile public markets, looked at Garmin's balance sheet, and chose peace. And a very nice premium.
I'll concede the certainty aspect. But man, Garmin Connect absorbing Strava's premium features? That's practically a monopoly on middle-aged guys in Lycra.
It's a brilliant consolidation play, but it also proves my broader theory. M&A is the only viable exit strategy right now if you want a premium valuation, which perfectly explains the absolute feeding frenzy we're seeing over in biopharma.
Oh, you mean the Q1 gold rush? 46.8 billion deployed.
19 deals in 3 months. Big Pharma is absolutely terrified of these looming Parton cliffs.
Eli Lilly dropping 7.8 billion on Centessa really set the tone.
And Servier grabbing day one for 2.5 billion in pure cash just confirmed it. They're buying pipelines like it's supermarket sweep. We really need to look at the clinical data Lilly just bought themselves. Tomorrow's radar.
I'm refreshing my terminal tomorrow morning just for the K car filings. 830 million to the KG Group Consortium. And I need to see exactly how that debt stack shakes out.
You're weirdly obsessed with Korean used cars.
It's the financing structure. It's a pure bellwether for Asian private equity.
A bellwether? It's highly specific. I'm watching European life and pensions. Chesnara is practically screaming that they're going on a shopping spree.
Life and pensions, yawn. I'd rather read Garmin's integration plan for Strava.
Oh, come on. Chesnara just swallowed HSBC Life UK whole, and now they're teasing a massive M&A pipeline. It's not a yawn if you appreciate actual cash flow instead of whatever Strava's IPO bankers were projecting.
Hey, those bankers are in mourning right now. The S1 was at the printer before Garmin swooped in with 2.1 billion.
Good. Less reading for me. I prefer my tech exits in actual dollars, not theoretical roadshow math.
Cold as ice. We'll see who writes the biggest checks tomorrow. Catch you on the tape.